So, all right. Well, we're a few minutes after 12, so let's get started. Thank you for those that are jumping on in. We're glad that you're here. And we are excited just to kind of dive into this topic. There's just been so much going on in the insurance world in lots of different ways, affecting people differently. And we're going to jump into all of it. So before I do, though, I do want to introduce my special guest, Adam Thurmond. He is with Farmers Insurance down in Burlington. But of course, you serve outside of Skagit County, right, Adam?
We sure do. Yep, we do.
Yeah, I know I use you a lot in Washington and in Skagit. And you and your wife, Rita, you own your business and you work in your office together. I know I get her on the phone a lot when I call in. She's so sweet. And you've got 3 employees. You've got Misty, Ramey, and Christina, right?
That's right.
Awesome. And you guys live in Burlington and you've got 3 kiddos. We were just talking about our kiddos. You've got Noah, Olivia, and Madeline all in elementary school. So what grades are they in?
So Noah and Olivia are twin brother and sister. They're in 6th grade. And Madeline is a 4th grader.
All right.
So they're all within a year and a half of each other.
Okay. Well, Noah and Olivia will be at high school with William before he graduates because he's a freshman.
Good.
So just maybe their freshman year, he's a senior. Yeah, I don't know. I can't.
Sounds right.
And you grew up in Burlington, so you're a local boy, and you've been part of the community your whole life, which is awesome that you're giving back in this way. And I hear you volunteer at church, you love baseball, and which you've coached for many years, and that you love vacationing with your family.
All those things are true. Yeah, you pretty well nailed me down right there. That sounds right.
Oh, well, wonderful. Well, thank you again for being my guest. For those of you that don't know Adam, it's been a couple of years ago, I think I met you, and you've kind of been my flood insurance guy. So in the real estate world, when we have a house that might be in a floodplain and we need to get a flood insurance quote, we have to have a reliable insurance agent to call that day. And Adam has been amazing, and he was referred to me by many people, a lot of my lenders that I work with. And great. You always, if you can't answer the phone right that second, you always call me back as soon as possible. You're fantastic with my clients, so knowledgeable, so on top of it. And so that's why I wanted to bring you on as my guest today to expand beyond the flood insurance topic and dive into all things insurance, because it's been kind of crazy. Just a few weeks ago, I got my renewal in the mail and my auto insurance went up $300. My home insurance went up $600. And I didn't do anything. I didn't change anything. I didn't buy a new car. I didn't add one of my teams to my policy. So what the heck is going on?
Well, that's probably the perfect intro question, because, and I think over the next 45 minutes, we'll hopefully cover it there, because there's really not a one-word answer to that. There's a lot going on. There's a lot that has been going on for a few years, and some of those things are kind of now catching up to us. So basically what's going on is it is a nationwide thing that's taking place right now. It's been happening for the better part of 2 years, where we're seeing increases all over. Nationwide, we've seen homeowners policies increase 30 to 50% over the last 12 months. Sounds like you fall right into that. And a lot of people are asking that same question. Why is this happening? I've not filed a claim. I've not been in an accident. Why are these things happening? Well, there's really a series of things. If you think about what's happened over the last 4 or 5 years, a lot of things get blamed on COVID and inflation, right? But if we dive into really what happened with those things, there are reasons that these increases are happening throughout insurance. If you go back a few years and think about during those early COVID times, how supply chains were really affected. And we began to see prices on certain products really go up. You might remember used car prices went through the roof, and they've maybe come down a little, but not all that much. We certainly know what's happened with homes and the prices of homes. 5 years ago, most of these homes, to rebuild a home, it was about $150 a square foot. That's just not even close to what it costs anymore. We're seeing most of these homes, to rebuild them with lumber and labor rates, it's closer to $300 a square foot.
Wow,
So
double.
yeah, so just in a handful of years, we've seen that type of impact. So those are a few short reasons as to why, but there's much more too, and we'll get into that as we go through this hour. But those are a couple of the short, quick explanations as to why. Another thing to keep in mind: think about the events that have happened in the world weather-wise. Last winter, we had record-breaking freezing, just right here, right? Think about what's going on in Florida and the storms there, the fires. All of these things are impacting what's happening with insurance. And insurance companies work with what's called a combined ratio. A combined ratio is the insurance company's loss expense combined with just regular expense. So the loss, the outgo, their business expense, and then based on the premium that they're taking in. So that ratio comes up with a combined ratio. And when that ratio is in the 90s, it works for insurance companies. But what we've seen over the last few years, most all of these companies nationwide have really been hit hard with that combined ratio. As values of homes have gone up and replacement costs have gone up, frequency of repairs have also gone up. So that's a pretty bad combination of things to be happening at the same time. Increased weather events with more expensive fixes have led to this combined ratio getting out of whack for insurance companies. And so they take certain measures that have led to what we're seeing today. It's interesting because insurance it's regulated at the state level. So you might see that Washington State or Oregon is impacted in a different way than California or Texas or Florida. But I think something we may hit on today is some insurance companies are leaving certain areas, right?
Yeah, I was curious about that because how does that affect the ratio? I mean, obviously they have fewer liabilities if they're no longer in that state, but they're also missing out on all that income too, and I know that there's a lot of insurance companies pulling out of California and Florida for obvious reasons, wildfires and hurricanes and everything else. Yeah, how does that work? And then I've also heard that there's companies pulling out of Washington.
Great question. So each state is regulated at the state level for insurance. Okay, so when Farmers Insurance or Progressive or State Farm or Safeco or whoever wants to make a rate change, they go to their state's insurance commissioner's office. That state either approves those changes or does not approve those changes. Another thing that happened during those COVID years is a lot of those changes were not being approved at the state level. So there was some pent up demand there that kind of is flushing through all at once. But it's different at each state. Okay. So there are cases where an insurance company may not see a path to profitability in a certain state because the rate changes submitted to the state don't get approved. And so if that ratio is out of whack, what's the insurance company going to do? They're going to submit some changes that either are going to get approved or denied. They have to provide data to justify those changes, a reason why those changes are valid and should take place. If they're declined, there are cases where insurance companies in a particular state may not see a path to profitability. And that's where you see insurance companies pull out of a certain state. It's happening heavily in Florida. It's happening significantly in California, like you mentioned with the fires. To a certain extent, it's happening in Washington. It's nowhere near as severe as what we're seeing in some of those other states. But there are a few carriers that have left the state of Washington. And that's the main reason why. They couldn't get rate changes through. They didn't see a path to profitability. And so they've just closed up shop in those particular areas. Fortunately, in Washington State, while we have seen increases, we're not seeing a max exodus like some other states have seen from insurance carriers. Most of all the names you're familiar with are still here in Washington State.
So, question, do you think eventually, if you're with a national carrier and that carrier is no longer in those high expensive states that have a lot of natural disasters, will that trickle down to us as consumers that maybe that carrier, we aren't going to see as many increases because that particular carrier is not in those states? Because I think, you always hear, oh, we are being punished, or we're having to pay for the hurricane damage or the FEMA stuff, the stuff happening in other states, not where we live. So is the reverse also potentially true, that as they pull out, that actually may safeguard some of our premiums, as hard as that is on people living in those areas?
I want to understand your question. So I'm sorry, I don't, forgive me, I don't
I threw you a curveball. Yeah, I'm just curious if, if my insurance carrier pulls out of Florida and California, let's say.
Yep.
Does that mean that maybe my premiums won't keep going up as high over the next couple of years because they're no longer in those states?
That's a great question. There could be some truth to that. For the most part, insurance is based at primarily the local level. I'll give you an example of that. There are impacts here in our part of the state that we are not being punished by, that are being punished for in the Spokane area. And an example of that is the Spokane County, that area has seen a significant increase in hail damage. So that part of the state, on their homeowners insurance premiums, is being that's becoming a heavier weighted factor in the underwriting of the homes in that area. So while your question is, there may be some truth to that, where if we don't have Florida, maybe that helps some, but it is pretty regionally based. And so if there's something that impacts somebody in Spokane that isn't impacting us, at least with farmers, those individuals in Spokane are getting, kind of hit with that. But fortunately over here, we are not. So that, hopefully that kind of answers the question.
Yeah.
It probably does to a certain extent, but I think there's some limitations there too.
Well, that's definitely good to know. And I do want to talk a little bit about homeowners insurance. One thing that you had mentioned was obviously the cost to rebuild has literally doubled since the pandemic, which makes a lot of sense. Prices of wood, labor, everything else. My question is, so like I said, I just got the premium renewal in the mail and my homeowners went up quite a bit. I did not report any remodel work or any changes in my home. So does that mean that they automatically added the additional cost it would take to rebuild? And here's why I'm asking, because a couple of years ago, I know of a few local people that had home fires. And at the end of the day, they were underinsured. Their policy did not cover the cost of the rebuild. Now, this was between the beginning of the pandemic and now. And so my question is, with the increase in the premium for me, am I covered? Or do I still need to call my insurance company and say, hey, this is what we've done. Maybe we've added value here. I mean, I know the value of my house because I'm a realtor, so that's easy for me. Or is it automatically covered with that increase? Does that make sense what I'm asking?
Absolutely. And the answer is most likely yes and yes. So, and I'll explain why. You should call your agent. You should, if you've made changes to your home, if you really did a significant remodel in that kitchen and you have different product, or you haven't had an addition to the house, that's important information. It absolutely is. And if you don't do that, there's really no way for your agent to know that those have taken place. So minor changes, probably aren't necessary. But if you do something fairly significant, you certainly should share that with your agent and work with your agent to arrive at what that coverage adjustment should be. As for 1 year to the next, there's a couple of different types of policies. There are replacement cost policies, and there are actual cash value policies. And actual cash value policy is usually going to be insured at a stated amount or an agreed upon amount, where it likely isn't going to change from one year to the next unless you guys talk about it. Most of your clients, you're selling a home, those clients are going to have replacement cost policies on their homes. And on those policies, with most carriers, you're going to have kind of an inflation guard. And so those policies are going to adjust each year with inflation. So there's a built-in mechanism to make sure that you do have enough coverage, that it continues to increase each year. So it used to be, from one year to the next, we might see on a $500,000 home, it might go to 512 next year in dwelling coverage, where in these recent years, it's taken a much more significant jump than that because of the increases that we've seen. One other thing to keep in mind, a lot of homeowners policies, not all of them, but many of them will have an endorsement or a coverage that's called extended replacement. It'd be good to make sure that your policy has that. It kind of works as a buffer on top of your dwelling coverage amount. So if you have extended replacement coverage that might be, say it's 25% of your dwelling. So if you have a $500,000 dwelling coverage amount and you have 25% in extended replacement coverage, that would mean you have a buffer on top of that 500 of 125,000 more. So that could come into play in the event of a fire, in the event of a total loss. You're rebuilding this home, 500 should cover it. But as we've been in times where pricing has fluctuated, if that 500 doesn't cover it, that little buffer is there, which helps to make sure that project is completed and rebuilt. So extended replacement coverage, that's a great question to ask about on your policy, if you have that on your policy. And what is the percentage? Is it 10%? Is it 25? Is it 50? And if you don't have it, does my policy qualify for it? It's an important coverage to have right now as we're in a time where pricing just is kind of a moving target.
Exactly. Well, that's great. That's a great tip. I wrote it down. Extended replacement policy. What's the percentage? Does my policy cover for it? That's awesome. I appreciate that.
Yeah.
Something else that's been real recent, I mean, literally in the last couple of months, I just had a client where, we're getting ready for the market. And a lot of times it's like, you have to weigh out pros and cons of remodel work or replacement work to do prior to selling it. And as far as I know, roof is fine, no leaks, everything's good. And I call them up, check on them, and they said, oh, well, we have to replace our roof. And that's not usually something I advise to do if it's not necessary or obvious. And I'm thinking, why are you replacing your roof? And they said, well, our insurance would not renew our policy unless we replaced our roof. I've never heard of that. Talking to my contractor, I mentioned to him, he goes, oh, yeah, I just replaced 3 last week for the same reason. So what in the world is going on?
Yeah, no, there's a ton of that right now. None of us like to be watched or spied on, right? But technology is changing the world every day. And that certainly is true with insurance companies too. Aerial pictures are pretty easy to come by these days. And there's a difference. Maintaining your home is very important. And that's a big part of eligibility for homeowners policies. So what we've seen these last few years, as that profitability or that combined ratio has gotten out of whack, companies have done a couple of things. They are, one, rates have gone up some, but they're also tightening eligibility. So one of those things is roofs are a big offender when it comes to water losses in homes. So we have seen that throughout the industry where homes with roofs that might be a little bit older, it's tough because some of the time that roof might not be all that old, but it's in an area where moss really gathers or it really appears to be older than it might be. So maintenance on a home is really important. It's a good thing. Know that your insurance company is likely taking pictures from the sky. I mean, I think they all are now. And so those pictures and other things, things like debris in your yard, if there's garbage all over in the backyard, they see that too. And that can be a hazard. And so it's kind of a tough one because you feel like it's a little bit invasive. It's your yard, and I totally get all that. But those also are underwriting eligibility issues when it comes to a homeowner's policy. So yes, that is happening. Not seeing it as much over the last year. There was quite a bit of it, heard a lot about it a couple of years ago. But I know it is still happening out there. But on a side note to that, as a homeowner, it really is important to maintain your home too.
Totally.
One of the best ways to minimize future losses at your home is to stay up with the maintenance, and roofs are certainly part of that because it's in most cases it's the first line of defense from most of the weather that we see. So
do you know, Adam, with our insurance companies, I know when you buy a home, they always want to know how old the roof is, as I'm sure they're filling everything in. I think a lot of us don't necessarily call our insurance company if we replace our roof because we're not adding like additional value. We're not remodeling. We're just replacing the roof. But is that something we should be doing too? Because are they looking at the age of the roof as part of this process for eligibility and forcing people to do that? Because if they're not just taking drone photos, are they looking at the information we've given them in the past, and should we be updating them on those things?
Great question. If you replace your roof, I would absolutely let your insurance company know, and I would even pass along the paid for invoice or the paid receipt. In many cases, you might find that you get a discount for that. That may not be the case with all carriers, but if you have a paid receipt for a roof that's been done recently, there's a fair chance that you're going to save a few dollars on your premium.
Well, who doesn't want to do that right now, right?
Go. Yep.
Yeah, that is awesome. I love that. Okay, making a note of that. Also, just putting it out there. If you guys have any questions, feel free to make a comment. We will see those and we will address those at the end if we don't already address it during kind of all the questions that we, sort of the top questions that Adam's been getting lately. So I think we talked a lot about just making sure, we're letting our insurance company know. I mean, similar to when you get a new car, you get a new policy. I'm assuming it's also good when you change valuables to make sure your insurance company knows that those are covered in that policy. One question I get all the time as a realtor in this market, especially from people moving from different states, is one, do our policies usually cover forest fires because they're not as common for us? And two, earthquake insurance. Is that usually part of our homeowners because of where we live, or do we need to make sure to add that in?
Great question. And I see that Corby Warline has put a question up here about some exclusions too. So we can kind of answer these together. So earthquake is not going to be part of a standard homeowners policy. That will be an exclusion on homeowners policies. So if earthquake coverage is something that you're concerned about, we keep hearing about the big one here in this area, and we've not really seen it, but it's likely to come at some point, right? So earthquake insurance would be its own separate policy, a lot like flood insurance is. Flood insurance is another exclusion that makes a lot of sense in certain areas and maybe isn't necessary in others, but is an exclusion on your standard homeowners policy. So let's say you had flooding at your home and you had a bunch of damage to contents in your home. Those contents wouldn't have coverage. The home would not have coverage. The same is true with earthquake. Fire is different. Your homeowner's policy, another name for your hazard insurance, is fire insurance. So your homeowner's policy is going to cover you for fire. So you're good there. You don't need a separate policy for that. But earthquake and flood are certainly a couple things to consider based on wherever you're living. And other exclusions, to answer your question, Corby, here's kind of what I always tell people. Maintenance is a homeowner's responsibility. Things like wear and tear are not covered on a homeowner's policy. So sometimes we might think I have this homeowner's insurance, it's gonna fix everything. But if you have something older that's worn out, might be a little drippy faucet, doesn't seem like a big deal, but over time that becomes a rotted out floor, there's exclusions for that. So if you see that little thing that isn't happening, it's not an event, it's something that's just kind of worn out, that's over time causing a problem, you're going to see exclusions for that in your homeowner's policies. The difference, let me contrast that to a water event that takes place. You have a pipe that freezes and bursts, and now there's water all over, and you need new flooring. That's a totally different scenario. Your homeowner's policy is going to typically cover those things that are sudden and accidental. Mm-hmm. So if you have this slow leak over time, it's likely not going to have coverage on your homeowner's policy, or at least standard policies. So whereas contrast that to the event that takes place, now all of a sudden water's everywhere, you're going to likely have coverage for that scenario. So again, maintenance is so important as a homeowner. If you see something little that doesn't seem big, but it's been happening for a while, know that those little things often turn into big things, and then you've put yourself in a situation where your insurance may not be there to help you with that.
Well, that's true. I always tell people, if it's sudden, you didn't know about it, it's usually covered. Another thing, though, that is interesting is that I've heard recently, and this happened on a house I had listed last year, I think it was, and the house had previous policies that had been taken out on it for whatever reason. It was an older home, so over the years, there were different claims. Sorry, I shouldn't say policies. Claims, insurance claims for whatever reason. When the buyer went to get insurance, because they had a loan, right? So it's required. They had a hard time getting affordable insurance or insurance that would even cover that structure because of the previous claims. And I had never heard of that before. So I would like you to talk a little bit about that. And also, I have heard that not only do the claims kind of affect the house for future, but they follow the owner. So if that owner made a claim, they go on and buy another house, that they may be affected by how many claims they've put in or their past. Can you speak to those?
Absolutely. So this is another, symptom of what we've experienced in recent years. One of the challenges is with eligibility with insurance companies is that eligibility guidelines sometimes change. And so a few years ago, that one claim may not have been an issue, but now it may be. And that's hard. That's a hard kind of pill to swallow. But as things have tightened, as guidelines have changed, eligibility has gotten a little bit tighter. We do see that sometimes a claim does impact eligibility on a new home that you're going to go buy, whether that's a home that you're going to buy and had a claim on it last year. There may be impact there. There's not always impact. Not all claims are equal. So there might be, and not all companies are equal, right? So, shopping with different carriers is a good idea because it might be that Company X looks at this type of claim differently than Company Y does. There likely is impact on both ends, but it might be ineligible at one place and just have a surcharge in another place or something like that. But it is true that claims do stick with you, and they also do stick with an address. So if you're looking to buy a home that had a recent claim, it may have impact. Not necessarily that it will, but it may. If you had a recent claim on your home, it may affect you at the next one that you're looking at also. So one of the things we encourage our client. I mean, we try to talk through claims. Things come up, and there's times where the best option is filing a claim. We really try to talk through those situations with our client now because they do have more impact. I wish I could always say that I know if this will impact you going forward. I don't always know that, especially in the environment that we're in now as things are fluid and changing. But we are seeing, I will say this, we're seeing it trend back the other way, where fewer claims are impacting us as they were, say, a year ago. So that's really good news. And we've seen that with other carriers as well. So claims are a factor. I would encourage you to work with your agent and think through the process of the claim. If you have a $2,500 deductible on your home and you have a pipe that broke, caused this water damage, and it's a $3,200 in damage, is it worth filing that claim?
For $700, basically.
That's a question that's better for the homeowner to decide than me, but I'm going to ask them that question. It's going to be different for everybody, right? We usually encourage people to, and we'll probably get into this, we're going to talk before we're done here about some ways that we can save money, the ways we can reduce some premiums. I encourage our clients to maintain a deductible that is not out of reach, not some crazy high number, but also something high enough that you're not, I guess, doesn't make it so easy to file a claim, because it's really not in your best interest to file a claim.
Right. You're going to think hard, right? I mean, your deductible's $500 versus $5,000.
That's right.
You're going to think a lot harder. It's like, is the damage so much that it's greater than my deductible? Because that's what makes it worthwhile. And that was the thing I wanted to bring up too. And I know Sydney's got a question as well about lowering your premium. So my understanding is if we have a higher deductible, right, then our premiums will come down. So we are saving money on a monthly or annually basis, even though we might have to pay more later. But that's also going to keep us a little bit out of hot water to have too many claims that are going to follow us and make it more expensive later, right?
Yeah, that's correct. So yesterday I was reviewing a homeowner's policy with a client, and they had $1,000 deductible. And I just asked them, I said, so if such and such happened at your home for $1,000, would you file a claim? And he said, well, of course not. So then we should talk about your deductible, because you're paying for something that you're not going to utilize. You pay for whatever your deductible is. So if your deductible is $1,000, you're paying in your premium to have it that low. If you wouldn't file a claim until $500 or $7,500, it really doesn't make sense to have a deductible lower than that. It's costing you money to have that warm and fuzzy deductible that's lower than what you would file a claim for. So yes, increasing it to $5,000, in this case, it saved him about $450 a year by going from $1,000 to $5,000. So it made all the sense in the world to him. We've done that over this past year. I'd say we've had a couple hundred clients make that adjustment, just because we've talked about it and they've come to the understanding, well, yeah, no, I'm not going to file $1,000 claim. Well, then let's not have you pay for one. Let's increase your deductible and have it make sense and save you the money. So great question.
Yeah, that's awesome. I know I'll be calling and adjusting. Yeah, because again, I wouldn't do that either, and that'll probably save a lot of money. And I assume similar with your auto, right? Like you can play with the different levels depending if you have a loan or not and what needs to be required. But I heard a crazy stat that 1 in 8 drivers are uninsured. Do you know if that's accurate, or is it greater than that? Or
I think that's an inaccurate stat. I think it's higher than that. I don't know the exact number. I do know we take claims calls, right? And I do know, I mean, I don't keep the stat, so I hate to even quote a number, but I would guess that 1 out of 3 claims involves an uninsured driver.
Wow.
And so on your auto insurance,
yeah,
you've likely seen increases on your auto insurance. probably the biggest reason why. If you look at your auto policy today versus, say, 3 years ago, the portion for uninsured motorist, it's gone way up. It's gone up more than any other coverage that I'm familiar with. There are more uninsured motorist claims than ever. And so the charge for, I mean, it used to be if I run into you, my insurance is fixing your car, right? And paying your medical bills. Well, if I'm not insured, your insurance is paying to fix your car and your medical bills. So your insurance is impacted by an increase in uninsured drivers and uninsured events that take place. And so as we've studied these policies and seeing, you know, because there's many different coverages on an auto policy and they all have a cost associated with them. And we've seen that the uninsured motorist portion, that's the portion that has increased by far the most of any of the coverages. So you might ask, if I increase my deductible on comprehensive and collision, is it going to make a big difference? On the home, that deductible change makes a pretty big difference. On the auto, unfortunately, it doesn't make as big of a difference. It will make some difference, but there's many different coverages on an auto policy, and the comp and collision isn't being affected quite as much as the one that's really gone up, which is that uninsured motorist portion. So yes, it's a way to save a few dollars. You might be disappointed, though, that it's not as much as you might think it is to increase those. It's worth asking, totally worth asking. Yeah. On the home, it's pretty good impact. On the auto, sometimes it's worthwhile, sometimes it's not.
Any other tips for auto, how to save, or, you know, because Absolutely. A lot of us are responsible and we are going to have insurance on our autos, unlike a lot of other people.
Yeah, no, I definitely have some thoughts there. Deductibles is one of them. Unfortunately, with autos, it tends to be a few different little ways more than one big way. Okay. It's important to review your policy with your agent. If you have a car that you've owned for many years, maybe it's a 2005 Honda. It's a good car, but now it has 208,000 miles on it. Is it still worth maintaining collision coverage? It may be, but it may not be. It may not be. There's several optional coverages on an auto policy. They're all great coverages. You might find that you have double coverage somewhere, though. If you have AAA, do you really need towing and roadside service on your auto policy? You might be paying for it twice. So reviewing those things is important. I personally, on my auto policy, I don't carry rental car coverage on my auto policy. A lot of people absolutely want it, and it's right for them. For me, I've never had to rent a car because of an accident that I've been in. So for me, I'm kind of like, you know what? If that scenario ever comes up, I'll figure it out and I'll just go rent a car. Whereas it might be costing you $50 per car every 6 months to have that on there. And so for me, that's a coverage that may not make sense. So, but each coverage is different. So unless you review it, you know, it's important to review it, because it might be that at one time a coverage made sense for you to have, but now as years have passed, it may not make sense anymore. The other big thing that we've seen with auto, cars are so expensive now. I mean, cars are so expensive now. And so every time a car is totaled, it's not a $20,000 car that we're insuring. It's a $60,000 car, right? I mean, so if you have young drivers, the most expensive drivers on the road are your 16 and 17 and 18 and 19. I mean, your youthful drivers. If you've got a fleet of brand new cars in your family with a couple of 16 and 17-year-olds, you are not going to like your insurance premiums. I know as my kids are coming along, they're not driving yet, fortunately. It'll probably be double again here by the time they are. But in my family, we're going to have a few older car. I mean, probably not beaters, but we're going to have some older cars. I'm not going to buy a brand new truck or a brand new car as my kids are about to turn 16. So, you can find good used cars. And during those times where your insurance is getting hit and impacted by young drivers, that's a good thing to consider. Some people don't think about the insurance portion until after they buy the car.
Well,
Call
my
your agent.
understanding is too that your young driver, because I'm right in the middle of this right now, I have a 17-year-old and a 15-year-old, that they are on your family policy. They're not just associated to one vehicle, because
That's right.
they could potentially be driving all your vehicles, right?
That's right. Yeah.
Yeah.
So it could impact it. It likely will impact each of the cars on your policy as a whole. So yeah, it's important to think about, what's the impact of this purchase. Everybody always looking at, how much am I paying for the vehicle? It's a lot, and you've still not even accounted for the insurance portion, which may go way up. If you're going from a 2008 to a 2024, you've got a surprise coming. So
good to
call
know.
your agent
Hold off
first.
on buying those new cars until
Yeah, or
it's
at
like
least know what
remodeling
you're in
the house
for.
after the kids are grown, right? They're not
Yep.
beating it up anymore.
At least call your agent first, right? Say, hey, I'm thinking about buying this. Is it going to impact me all that much? Sometimes it won't, but often it will, especially if you have young drivers in the household.
Yeah, that's an absolute great tip. Yeah, definitely. I hadn't really thought about that before, and like I said, now that I'm in it. I have a question though, and I've heard different answers. So who's more expensive to insure, assuming both are good grade students and, similar? Is it the teenage boys or the teenage girls?
It's us boys.
Oh, it's still boys. Yeah,
Yeah,
well,
boys.
I got two of them. So
still boys.
I will say,
we just don't figure it out quite as quick as you girls do. We're a little bit slower to the party.
Frontal lobe not being developed. I will say for parents, if with upcoming drivers, the Life 360 app is amazing. We use it all the time. I can actually see how fast my son is driving when he's driving. So I can literally watch where he's at. Now I know it's like kind of creeper status. However, we want to make sure that they're safe. And, I may have been known to text his brother who's sitting next to him saying, tell your brother to slow down. Because he's doing a little faster than he should. But it is a great app to keep tabs on them and make sure that you're parenting them, through that, because they don't understand the consequences. And the consequences could be as small as our insurance is going through the roof, right, to as great as, loss of life. So it's a serious thing. And and the drivers today are crazy. I feel for my kids, but we live right on the freeway. So they have to kind of figure it out pretty quick, and they're doing so. But at least now we can have them get a whole year in advance of driving experience before we put them on the road.
There you go. Can I add something there?
Yeah.
Bundling your policies is another way to save, right? You might have your flood insurance here and your home there and your auto insurance there. You're probably leaving money on the table doing it that way. There's a lot of different discounts for insurance. Your employment might provide you a discount. So if you go to your agent, they might know that you're a school teacher. They might know that you're in the military, but they might not. So you should let them know. And then if there's a discount you're not getting that you might qualify for, they can get that added. But wherever your homeowner's policy is, wherever your auto insurance is, it's a good idea to at least look at and see if combining those in the same location is going to provide you discounts to save money. But there's various ways, various discounts, but the bundling one is a significant one, whether it's a life insurance or an auto or multi-policies with the same carrier is usually going to save you some money. But things like employment, good student, you mentioned that, Carmen. There's discounts out there, and it's different for every insurance carrier, but that's a good question to ask. Hey, what discounts are there out there that I might qualify for? It's likely they're all accounted for, but there might be one that's not, that might save you a little bit. We had someone the other day, we didn't know they were a school teacher, and it ended up saving them about 18% on their homeowner's insurance. So that's pretty significant, going from $1,180 to $1,000. I mean, that's a good savings. So knowing that can save you a few dollars.
Do you guys, by chance, is there anything for seniors? do they get discounts? I mean, they've been driving a long time, usually good record. Is there anything for them?
Thank you for asking that. It's a hard one. Here's what, and seniors are getting hit really hard right now. Really hard with, I mean, just across the board, right? And insurance, they're getting hit hard there too. And it kind of breaks my heart. We insure several retirement facilities with condo associations, and those there's limited options there. Auto insurance, for example, it accounts for age, whether it works for you or against you. A 16-year-old drive, there's kind of a graph, right? And statistically, that's what it's all based off of, right? I mean, I love my mom. I want her to have the lowest premium that is out there, but where she falls statistically means that she's going to pay a little bit more, unfortunately, than she did 10 years ago. And unfortunately, that is a reality in the insurance world. It's a challenge. We work with a lot of seniors, and we try to find whatever angle we can to save them, because I know they're getting hit hard from everywhere right now. But it's a challenge. So those discounts, that if you're a retired teacher, if you're a retired military, we definitely want to get that in there for them, because that's a way they can save.
So what about families where maybe their parent has now gone into assisted living, they no longer drive, but they still own the vehicle, still should be insured in case a family member drives it? Is that a good thing call? And what can be done in that situation?
Yeah, that's a good question. We have a couple of clients who have a similar situation. There might be a mother and a daughter on an auto policy. The mom owns the car. Daughter drives mom around. We exclude the mom from the policy if she's not going to drive. So she's not accounted for in the pricing, but it's still her car. She owns it. Daughter's insured to drive it. So there's some things you could do. I'd encourage you to work with your agent in scenarios like that. But that's a perfect example of work with your agent to find out what the best solution is to not pay more than you have to.
Well, it sounds a lot like in real estate. It's never a one size fits all. It's always custom based on what the client's, their needs and wants. And it sounds like same thing. You should be sitting down with your insurance agent at least once a year, right? Going over your policy. What are the changes that have happened in your life? What's coming up? And looking at some of those things that maybe you don't need, adjusting some different, premiums and coverages here and there to make it more affordable, or also to make sure that you're covered that maybe you didn't realize you're not covered in certain situations. I know that, if you're buying a home, it's really important that you reach out to insurance early, because things have gotten more expensive. It can throw off people's pre-approval amounts. If insurance was before, $50 to $60 a month, well, it's not so much anymore. And so if your lender's accounting for that, it's going to make your payment so much. But when the reality comes in and it's twice that, and now you may not be able to afford the same house. So definitely talk about insurance early and find out what you qualify for, what the house qualifies for. I'll also put a plug with flood insurance. The nice thing that has changed with flood insurance, and Adam can attest to this, is that it now is with the house. It doesn't have to do with the individual. Is that still true, Adam, where I can call you and say, what is the quote for this house? Not this borrower going into the house, but just this house. Yeah. Makes it a lot easier. The other thing I would note too is, if you're not buying in a floodplain, but maybe you're near one, you might want to have a conversation with your insurance agents. One thing we've seen nationwide is floodplains have changed, right, over the last 5 to 10 years. And it may not have been in a FEMA floodplain and didn't need to have flood insurance per your lender. But lo and behold, a storm event happens and your house floods, and now you're not covered because you didn't have flood insurance. So I would just say, look around. If you're close to a floodplain, might be worthwhile adding, like earthquake, adding it on. Because we saw a lot of that back in when the Sumas area flooded, right? That there were people that weren't covered because they weren't in a floodplain. But Mother Nature had other ideas. Any real quick thoughts on that before we go into Molly's question?
Yeah, that's great advice. We find we do a ton of flood insurance, and we find that most people that buy it are buying it because they have to. Mm-hmm. it's smart if you live in certain areas, and you know those areas. If you live there, you probably do. And if you don't, if you're moving to a new area, it's good to ask around before you move there, maybe. But here in Skagit and Whatcom County, we tend to know what those areas are. If you live close to one of those areas, it's worth a conversation with your agent for sure. Because we did see many of the places that flooded back in November of 21. Most of them were in that 100-year flood zone, but many of them were not. And so a lot of the people impacted by that flooding probably never, ever had a conversation about flood insurance.
Yeah.
And so we know those areas, we know those low-lying areas. FEMA may not have recognized them yet as being an area that's required to have flood insurance, but that does not mean it's not in your best interest to have it. So I think that's great advice, Carmen.
Oh, good. Exactly. Okay, I want to make sure we hit Molly's question before we wrap up. Molly said, we have an outdoor entertainment space with a barbecue and pizza oven. They had never thought to add that space to their insurance, but is it recommended? So I guess this would be also other outbuildings. Of course, they entertain here, they host there. There's obviously, they're cooking, so there's maybe some more risk there. What are thoughts on things like that you've added to your property and adding into your insurance?
Yeah, one of the coverages on most homeowners policies is a coverage for separate structures or other structures or detached structures. And it's good to review those. Sometimes you might build a shop in your backyard. You might build a fence. You might build a gazebo with the barbecue. You might build something that adds value. It costs you money. It's got real value. And so that's one of those things to review with them, certainly. Adding that onto your policy. It may be that it's already covered, because most homeowners policies are going to come with a standard amount of coverage for separate structures.
Okay.
Yeah. So usually, it depends on the policy, but it might default at 10% of the dwelling. So if you have a $300,000 dwelling, you might already have $30,000 in separate structure coverage that you don't need at all, but it's standard part of the policy. But then someday you build that shop or you build that gazebo or whatever you do, and that coverage is already there. Or maybe you need more. We get calls every once in a while. Somebody's building a big shop, and those are not cheap. So adding that coverage, it might mean that you need more than 10%. You need 30%. So yes, one of those things certainly to review with your agent.
One other question that's somewhat related, but we all just got our annual tax assessments in the mail, right? And they just keep on going up, it seems like, every year. Which, if you have questions on that, give me a call. I can help you with that part of it. But is that related to insurance coverage at all for your home, your tax assessment?
It's not. No. It's going to be totally separate. Typically, the tax assessment, as much as they jump, we don't like those jumps and those assessments, but they tend to be lower than what your replacement cost actually is, or certainly lower than the market value is. So market value is usually the highest number. Your home's going to be insured to a number lower than that almost always, because when you buy a property, you're buying the ground it sits on. What the insurance company is insuring is the home itself for reconstruction. So, and then the county usually will assess it at a little bit lower number, more of an actual cash value number than a replacement cost. So a depreciated number. Even though they're going up a lot, they're still a little bit lower than what the replacement cost is. So you might have $400,000 in a tax assessment. That doesn't mean that's enough to rebuild that home. So what we do when we're doing a homeowner's policy, we use a replacement cost estimator tool. We get online, we get the square footage, we get the photos from the listing, and we basically try to rebuild that house. And it pulls real-time data from the last 90 days from a given area from CoreLogic, and it helps us develop a number that is a very accurate replacement cost for that home. So that number is going to usually be higher than that tax assessed value.
That's really interesting, but that's great to know, that you guys are doing it in real time, what the costs are. Sorry, I've got shadows. Yeah. So it sounds like the first thing we all need to do is call our insurance agents, double check our policies, and dive right into it and make sure that we're up to date in all the things. If there's no other questions, before we just finally wrap up, any other thoughts, Adam? Anything else that you wanted to share with us today? I appreciate so much you spending the time and answering all our questions. And like I said, I mean, it's a lot. We've been talking for almost a solid hour, and I feel like we've still scratched the surface, right?
Yeah, there's so much more, and it unfortunately it can be a moving target, and so that's why the communication with your agent is so important. Be an advocate for yourself. If there's something that you need to go to bat for, don't be afraid to do it. Call your agent and let them be an advocate for you. But the communication is important. The home, it likely adjusts each year, right? The amount of coverage, but make sure that it does. Make sure that you're not on the wrong end of that if something happens where you're not insured enough. So I would say over communicate. We try to talk to our clients regularly. We have 5 here in our office, and so our phone lines are always full. But whoever it is that you trust and work with, call them. And if you don't have that person, you can call us. We'd be happy to help. But the communication is important. So you know what you have and know what your options are. And you might choose to forego something, but make it a choice, and do it all that you can to protect yourself in the way that you should. It's a big investment.
Yeah, last thing we want to be is surprised, right? When it really matters most. Well, Adam, what's the best way for them to get a hold of you? I think I see a phone number right behind you.
There's a phone number back there. We're located in Burlington on Fairhaven. We are the only farmers agency in Burlington. We're near Stowe's, but you certainly can call me at that phone number, 757-7000, area code 360. My email is simple too. It's my first initial followed by my last name, A. Thurmond @farmersagent.com. And I'd love to answer any questions or help wherever I can. I can be a resource. I'm a resource a lot of the time without even ever selling you a policy. So if you have questions about something and you just want to bounce something off somebody, feel free to call. If that means I help you with your insurance, that's great too. But I'm available and would love to help.
And I can attest to that, which is why you're my guest today. You're so great. You're a wealth of knowledge and always available. And it helps me so much in my business and with my clients. So thank you so much. Thank you for today. Thanks for tuning in, you guys. We are going to, this has been recorded. We're going to push it out so you can rewatch it if you missed, because it was a lot of information. And who knows, maybe we'll have a part 2 in the future as things keep evolving. So thank you again. Happy Halloween. I hope you enjoy your dad tax treats tonight with your kiddo.
Looking forward to it.
The rain will stay away and it'll be a clear evening for you.
Thanks so much. Appreciate you having me.
All right. Take care, Adam.
Take care.
Bye-bye.
Bye-bye.